Okay, good afternoon to everybody. We are going to begin the section, the role of financial regulation. And for this section, we have the participation on the right, Liang, Kramer Endowed Chair of Economics, Willamette University, Research Associate of the Levy Economic Institute, New York. Also, we have here on my right, Redge Nkosi, Executive Director and Head of Research, First Source Money, South Africa. He was also former Trade and Economic Policy Official for International Trade and Economic Development Division, Department of Trade and Industry, also in South Africa. And on my left, Fernando Fernanda Feil, professor of the postgraduate program of the Fluminense Federal University, sustainable finance specialist, and she is also coordinator of the Financialization Development Working Group from the Federal University Fluminense. And well, we will have two presentations. Just to say that Fernanda will present in Portuguese, so she will be the third in the presentation. We will need this translation. And so we can begin. Liang, please.
Is it here? Okay. All right. Good afternoon. So first of all, thank you so much for IDEAS and all the wonderful organizers for inviting me to share my thoughts here. It is really an honor and pleasure to do so. And also thank you to Margarita and other hosts to share this beautiful, extraordinary country with us. So my talk today centers around financial regulation. So I thought to put it in more international context, more about the capital account controls. And I also have been listening to all the insightful talks in the past 2.5 days. So I'm trying to pick up some of the sort of loose ends. So I could be maybe more coherent, but I think, it is a kind of important intertwining stories about why do we need to have a natural sort of suspicion, right? And we need to think about what exactly the limitations of relying on external financing before we can talk about meaningful design of control and regulation, right? Because we think our lives depend on these external financing, then I think it's very difficult to really try to regulate it, okay? So that's kind of my starting point. So if I can get this work. Oh, okay. Yeah, so this is a very quick contour. So I'm going to talk about, first of all, why finance must be regulated and drawing some theoretical analysis from, of course, Minsky and Jan Kregel, who, I'm very fortunate to have him as my PhD, advisor, one of them. So, so some of these things may not be new to you, but I think it's always helpful to remind ourselves. Then I'm going to kind of talk about the more Chinese experience. And so hopefully that will help to inspire more dialogues and thoughts about how we regulate external financing. So just to start, as we know, the mainstream view is that we need, private capital, right? It's sizable, from billions to trillions. I think Professor Ghosh talked about that. And criticize that view. Then we also have this idea that, the mainstream, right, that financial markets are efficient. They know how to allocate resources. And finally, the markets are self-regulated, right, because all these speculators, they're actually playing a stabilizing role by arbitraging away these price monopolies, abnormalities, right? And then from a developing country's context, right, this idea that we have to attract foreign capital because we have the so-called two gaps, right? There's the savings gap, there's the foreign currency, foreign exchanges gap. And so we have to rely on, foreign savings. And so the policy then is to liberalize, right? But of course, liberalization entails certain risks. But we need the so-called sound fundamentals. We need healthy financial institutions. And then you add some macro prudential policies and have the right sequencing, then things will take care of themselves, right? Sounds all good, too good to be true. So what does Minsky say? As Minsky pointed out, we have desequilibrating or the destabilizing force, right, in that financial capitalism, because we have all these assets and liabilities, right? Then the assets need to be financed. So we have all these, cash inflows and outflows. We have the cash commitments that are relatively certain. You know how much debt you're in, which again, we can't completely be sure these days with, I think Professor Lee earlier talked about the rate hikes of the Fed always, right, destabilize and, increase the unexpected sort of interest payments and so on. And then you have the operating income that is also relatively uncertain, right? You can only expect how much your operating income can generate and whether or not they'll be able to meet your cash obligations. So Minsky talked about the three different positions, the so-called hedge, speculative, and Ponzi. So before we get to that last quote there, I just wanted to kind of show, this is the chart that, oops, too fast. How do I go back? Okay. So just to say that we know that external financial flows are very volatile, right? So this chart just shows you how, for example, the portfolio equity and portfolio debt has turned negative since the end of 2001 and then 2022, right? As a response of the COVID, the rate hikes of the Fed, and so on and so forth. And we also know from a longer point of view, right? There has been more or less 4 cycles of financial capital inflows and outflows in the past 40 years. And none of these 4 cycles ended well for developing countries, right? 80s, we have debt crisis in Latin American countries. 90s, we have Asian financial crises. And then we have 2008, global financial crises. And now, again, we're start to see some market unsettling, starting with the Fed, then we see Japan, all these, potential, these uncertainties and risks. So this just goes to say, financial flows are very volatile, especially if you rely on these portfolio inflows. But still, even if these flows are relatively stable, right, this idea we can attract, foreign direct investment, which is supposed to be less fickle, there's still a problem, right? And I think this is what Jan has been saying, that by nature, if we're relying on positive net financial inflows to developing countries, then we are by design engaging in a Ponzi financing. Why? Because the rate of the growth of the inflows have to exceed the rate of the interest that we pay on the existing debt. To translate that, we have to borrow new to pay the old, right? We have to keep borrowing, keep refinancing in order to pay the existing foreign exchange debt, right? So this is a Ponzi scheme by design. Now, Jan also pointed out there are only 2 ways to end the Ponzi scheme. One is the bad way, right? And I think this is where many countries find themselves into today, right? About half of the low-income countries are in debt distress. About a quarter of the emerging markets are in the same similar situation. So the bad way is you can't find the next fool to refinance, right? The MDBs was, also said, well, there's not much we can do. And if you do want our money, you have to do this and that. We've been discussing this whole thing, right, for the last 2 days. Now, there's also one good way, which is we build real capital. We build real capacity, right? So progressively, we can reduce the need for external financing to finance the net imports, okay? So how do we do that? We create domestic finance, right? I heard that Reg earlier cited Keynes, right? Everything that we can actually do can be financed, right? Can afford. Here's another quote that one of my favorites by Foster, a great institutional economist, who's saying the same thing, right? Whatever that is technologically feasible is financially affordable, right? And how do we create finance? Well, we create domestically, either by sovereign government or the private sector under the guidelines and regulations of the government, right? So I think, again, we have talked about mobilizing, domestic resources. But what are the domestic resources, right? So for a lot of developing countries, the people, the human, right? So job guarantee could be very helpful to employ these real resources, public investments, and industrial planning and policies, trade regulations. We need to economize the need to import, right? Especially if we're importing luxury consumption goods for the elites. Maybe we don't want to do that. So capital account control, right? Which I will talk a little bit more about. So one of the things that I often hear, and we often hear, is that, well, developing countries, they don't have this and they don't have that. They have to rely on, net imports and borrow external currency because of this original scene, right? There's no local currency bonds that can attract buyers, right? We see that in the real life. Zambia, when they have the local currency bonds, the spread is like 20-some%, 30-some %, right? But the question here is, how much do we really rely on that net imports? These two charts, I think, are very illustrative, right? The top, the blue one, represents the developing countries, okay? As a matter of fact, when you look at the timeline, most of the time, the developing countries are actually running a net surplus on their trade account, okay? They're actually not relying on that net imports to support their economy. Low-income countries have more needs for those net imports. But again, we can talk about how much has this to do with colonial legacy, right? Why Kenya has to, export coffees and cut flowers and import all the food stuff, right? We could design a way to, cultivate our own agricultural, supply, so we don't have to be food insecure and so on, right? But again, so when we look at even just the low-income countries, right, the net imports is only about 4-5% of the GDP, which means what? Which means the rest of the 95%, they are grown domestically, okay? It's resourced domestically, okay? So the final word that I think it's important here to say, we need to rely more on domestic finance, to rely more on domestic resources. I don't know if the earlier quote, one of them also, oops, I'm still not very used to this clicker. The other thing that I think it's very important to, going back to this idea that finance can be created from within. I think one of the discussions that we hear a lot these days is, how can we utilize public national banks and development banks and so on and so forth. I think this is really on the right track, right? How do we develop this domestic financial system to provide finance? I don't have too much time to go into all this development finance literature, but I was happy to see that Studart was cited earlier, right? And I think he is also very inspiring in terms of how do we create, finance domestically. And of course, Jan has done so much work on, how banks are not intermediary, right? They are the acceptors. They accept others' liabilities by create their own liabilities. So I'm just going to go really quickly to this. I know that the time is ticking. I just love this quote, again, just to downplay a little bit the role of the private capital. This is again from Minsky. He says that, there are unimportant matters like the production of frocks, right? If you don't really this is dress, right? Old traditional dress. The length of skirts, the flavor of ice cream. My kids would say this is very important decisions. But anyway, these decisions can be made by the private market, right? But when it comes to distribution of income, economic stability, capital development of the economy, and education of the young, we need the public sector to do that, okay? So it's only when we understand the limitation and the danger of this foreign debt and this reliance on the external finance can we really begin to talk about meaningful control and regulation on the private foreign capital. So very quickly, China's experience. So it's a very staggered, very gradual process. It's, do the sequencing to its full extent. So I do have 2 minutes. Oh, great. All right. 2 minutes, 3 minutes. Oh, okay, great. So as we know that, China has been exercising this sort of capital account control since the very beginning of the reform and opening. Even though the current account has been deregulated, right? It has been opened, the current account in 1996, the capital account has remained under firm control of the government. So they differentiate the different types of investments. FDI has been encouraged, but still there are sectoral restrictions on these foreign direct investment, right? So there are sectors where the foreign investment simply is prohibited or limited, right? And again, I think also, even when the FDI is welcomed, I think the Chinese government has a very clear eye on what FDI can do and cannot do. And my own research has shown, when all these myths is debunked, we will have a better understanding of what we need to do to negotiate to make FDI work for us, right? Does FDI create jobs? Maybe, but it depends. They could outcompete domestic firms. And if they're very capital intensive, they actually destroy jobs on the net. Can FDI promote export revenues? Again, it depends, right? If they are very heavily reliant on import, they cannot really generate much of the net export revenues. Market-seeking FDI, they're trying to sell in your market. They don't necessarily export very much. And not to mention all the techniques that they've been using, right? Transfer pricing that we heard earlier. That could also reduce your export revenues and so on and so forth. So that really comes to the final, I think, to me, the only very sort of positive potential for FDI is that technological transfer, right? That's why you hear these days that the United States has been very sort of displeased, right? This whole idea of forced technology transfer. China is asking the multinationals to transfer their technologies. I think that is one thing to do, right? If we wanted to make FDI work is, give us your technology. You want our market, bring the technologies in. But again, there are thresholds. You have to have certain human capital. You need to have certain infrastructure. You need to have the research capabilities for the FDI to be willing to transfer the technology. You also need many other things, including your absorptive capacity and so on and so forth. So again, I wanted to echo what Dongo has been talking about, right? FDI is a very costly way of developing your economy, right? You have to pay hefty costs in terms of the profit repatriation and so on and so forth, illicit financial flows, you name it. So we need to be very careful, right, about what we can get from the FDI and how to really make it work. All right, so there's also regulation of the overseas direct investments. And then for portfolio, the Chinese approach has been very cautious. It has been setting up the so-called, it doesn't work. Is it deactivated ones? I only have 10 seconds left. Oh, okay. All right. So the managing of portfolio inflows and outflows, I know I don't have the time to go through this, but these are just very, much facts, right? So we can easily get some of these if you want to. All right. I think I should stop here. I don't want to go into deficit. Apparently that's not disciplined enough. So, all right. Thank you so much.
Good afternoon. Firstly, I do have a presentation. As a rational agent, I necessarily have to be very close to her. Some thinking, I suppose. So my discussion is on the role of financial regulation. My central thesis here is that as much as they are very important, they are, in fact, not helping us in reforming the current global financial architecture. In fact, they are, to a large extent, responsible for the challenges that the developing countries find themselves in. All right, so let's do this. Yeah, okay, good. So just a bit of history. If you look from 1990s, there's been a widespread of what we call the market-based, economic policies, repressing essentially what has been termed as bank-based types of policies because of the influence of the US and largely other countries in the West. And that decade of the 1990s, with that widespread economic policies that are market-based, came with it challenges in the economies in Asia, bank failures, and quite a number of challenges that confronted us. Not just Asia, Latin America here, and quite a number of places. But even if we were experiencing those challenges, we could see that the links between developing and developed economies were growing. They were continuing to grow. The reason, because of course there was a push, and the regulations at that particular point in time confined us or led us to continue to integrate. There's nothing wrong. Privatizations are things of the day, deregulations were continuing, and so on and so forth. But you see, we see therefore that after this crisis, some people began to wonder, is this the right way? Should we continue with market-based policies, or should we retreat? There wasn't, a way in which to find a correct answer to say, well, yeah, maybe we should retreat or not. The developing world, given the manner in which it's integrated into the global financial system, they continued to integrate. Until 2007, things fell apart. And then it was realized that, well, after all, macroeconomics itself was in trouble. Not just macroeconomics as a subject, but essentially even the regulations that flowed from that type of macroeconomics was also problematic. So it signaled, obviously, that there is a problem in the manner in which we've been conducting our businesses, in the manner in which we've been conducting our economics, and therefore some sort of change has to happen. Then, of course, again, driven by the big economies of EU and the US, some regulatory reforms had to come in. What are these? They had to dig back and look, 1980s, and we had to resuscitate the macroeconomic, macroprudential regulations. And they began to be imposed. Today, as we speak, they have re-emerged as the fundamental pillars that are going to help us deal with issues of financial instability right across the world. So, of course, capital controls have come in, but as you know, the IMF doesn't like the word capital controls. The phrase capital controls, they rather say we should have some capital flow measures, right? But the point here is that post 2007, we have had macroprudential policies defining our way forward. So we are, as we speak right now, in the midst of them, including capital flow measures. But we're also experiencing, however, some challenges there. We're seeing some spillovers. There's a lot of arbitrage on the regulatory front. And again, the countries that suffer are the global south countries. So how do we move? But also, what we're observing is that, it's like it's shifting. It's an epochal issue. The bilateral flows that used to come into the developing world begins to shift from, bilaterals into private capital. So private capital is essentially dominating through and through. So certainly the role of regulations becomes even more defined and more important with a view, I suppose, to controlling these flows of movement of capital. Now, well, these structural shifts from bilateral flows to now market-based flows are important to note for us. And the question is, for how long are we going to continue to have these flows in this direction, and what regulatory environment are we going to have to put in place such that we are able at least to relieve ourselves from the systemic risks that come with such magnitudes of capital flows. Now, what is emerging from for a look at this regulatory environment is that the flows of capital, the drivers of capital to the developing world, and the macroeconomic challenges and the financial instability that is being experienced in the developing world essentially comes from the regulatory environment itself, which regulatory environment or regulations are essentially from the advanced countries themselves. So the drivers of the capital flows is not necessarily the developing world, even if, of course, some developing countries are beginning to open up and so on and so forth. But essentially it's because the IMF, the World Bank, and all these other institutions are together processing us towards accepting that market flows of the nature that we're experiencing are important. If we, as the global South, are expected to grow and become, like the advanced countries. So, well, that is the case, but what does that mean? So the regulatory environment, I argue, is essentially promoting the old economics, I want to think. Some people may not call it old economics. The old economics of savings determining growth, nothing else. And the savings, where are they? The savings are obviously located in the global north. And therefore, the regulatory environment as we speak today is encouraging us to continue with the current financial order, financial architecture, instead of reversing to what my colleague here, Liang, talked about, private capital. Domestic capital. Keynes, as you can read there, sometime in his articulations, preferred what he says, domestic capital. He says, let finance be primarily national. However, we're so much caught up in this old economics, which says, well, only savings, which are now foreign savings from the global north, are going to sustain our economic development, are going to continue to save us from, the type of economies we find ourselves in. So regulations, good as they are, quite frankly, they're not as supportive. Right. So what do we do? Given the fact that regulations are important, but at the same time, given the fact that the regulations themselves are encouraging us to continue with the current financial infrastructure, architecture that we have. So I think that if we're going to have to move away from where we stand today as global South countries, one or two things we must begin to look at. From an academic perspective, that's why I think IDEAS and the University of the Federal, Rio de Janeiro, must begin to look at is that the current regulatory framework is essentially based on loanable funds doctrine. And the loanable funds doctrine, the way it understands banking, the way it understands money, is that money comes from one source. And that source is essentially the North. So if the regulatory environment is based on a framework, an academic framework, an academic thinking that funds and growth in the developing world can only be sourced from the global North, then quite frankly, the regulations are not going to do us any favor, and that we must begin to attend to it. Now, but also apart from that, we are seeing that the regulatory design is only done by countries that are in the global North. The global South, I'm afraid, is actually almost excluded. Even if there's some accommodation, just like being accommodated in the tax issues that we see in the OECD now that are going to New York, largely the design of the regulatory environment is essentially a European-centric one. When I say European-centric one, I mean, of course, I include the US. Now, if that is the case, then frankly, we should begin to say, how do we insert ourselves in the new system if we're going to have to change, if we're going to have some influence at least as countries of the global South? Furthermore, I think that the way the design of these, the way the regulations have been designed is such a way that they do not necessarily care about the conditions that exist in the developing South or in the global South. So they eventually, well, while obviously thinking about the global South, the maintenance is that no, it should in fact continue to protect the global North. and without which, obviously, the global economic architecture ceases, because then the global south will begin to act differently. So there are quite a number of areas which we can begin to look at, which we think affect the current system and are likely to continue to affect us, should we not begin to drive the issues our way. Now, so what do we do? Now, the presidency of Brazil, and next year, 2025 or thereabout, that of South Africa, I think must begin to insert on the agenda of the G20 regulations back onto the agenda in such a way that we should begin to look at these issues and begin to change quite fundamentally, at least if we're going to have to avoid the trap in which we're in. So yeah, current regulatory regime has to shift. While obviously Bretton Woods institutions are involved in perhaps training, but what they're trying to do is to get us to understand of how to implement the regulations which are produced by them, instead of us being at the driving seat like them, driving the changes in the regulations. So there's some advice that I think is necessary for us to deliver to the G20. I list these ones, but there are quite a number of them. This is my last slide here. I think the standard setting system must be such that the global south is accommodated. We are observing right now that money and banking are becoming highly digital. To the extent that that is the case, we should have a new standard setting body, and that would be one that deals with digital financial services. That's quite important. And that the divisions between banking and insurance companies, the regulatory environment around there is also quite deleterious. I think we should begin to ensure that the discriminatory approach that is there between banks and funds is let loose. And I think quite fundamentally is the fact also that within the environment, the regulatory environment, there is the provisions in there which seeks to degrade the rating agencies which would depend on as developing countries or the global south for grading our types of securities and matters there too. All that is embedded in the system where our our rating agencies are essentially not important if we have to be engaged in rating our securities and matters rated there too. We think that has to come to an end. And restrictions on our local credit agencies should essentially come to an end. Well, there are quite a number of issues that I would have loved to talk to, including matters related to carbon trading. Those two are very much stacked against the developing world. And to the extent that that is the case, I think we'll remain trapped in the global financial architecture that continually supports the global north, and the rest of us will continue to labor under the challenges that we've been enabling for the past 100, or shall we say now, centuries. Thank you.
So we are going to have the third presentation, Fernanda Feil, that she will present in Portuguese, so we will need the device for translation, please.
Boa tarde.
Good afternoon, everyone. Just a second, because I just disconnected my screen. I have to connect it again. Good afternoon, everybody. I will use the prerogative of being in Brazil, and I'm going to speak in Portuguese. Thank you very much. I know that it's a little unorthodox, but I think it's nice to speak in the country's language. Today, we're going to talk about financial regulation and the role of the restructuring of the financial system in the international financial architecture. I'm going to talk about a project that I am in with Professor Karen Feijó from the Fluminense Federal University, who is here. We understand, we study, and we notice that the reality that is imposed to talk about the restructuring of the financial system cannot stop thinking and considering the climate crisis. Climate crisis is no longer a problem of the future. It has immediate effects that we can already feel. Actually, it's a lot more than a climate crisis. It is a triple crisis. It is an environmental, social, and climate crisis. And the effects are intense, they are fast, and some biomes are close to their points of no return. The consequences are not going to be gradual, and they will not be predictable. They will manifest in different ways, in different states and different regions and economic sectors. And facing this triple crisis requires a transition, a green, sustainable transition that is defined as a change, an intensive change of economy from an intensive carbon generation economy to low carbon economy, minimizing the loss of biodiversity and social inequalities. It is a transforming change to the economic structure towards a more sustainable economy. This transition must be characterized by the reduction of structural heterogeneity and the increase of productive density. It involves, therefore, a comprehensive reconfiguration of the production systems and the consumption patterns that we have until today, and the investment patterns to align with environmentally friendly principles and socially inclusive principles. The purpose of a sustainable green transition is to foster an economy where knowledge and development are especially detached from climate damage, environmental damage, and social damage, and where the purposes of this growth and development are more uniformly distributed among the different territories and groups of people. Thus, the green sustainable transition is not only an environmental agenda, not only an economic agenda, but it is a political approach above everything else that integrates ecological sustainability with social equity, fostering a resilient, inclusive economy that is able to answer the needs of people in the present and in the future. Reaching this transition places the financial system in the center of this discussion, because the financial system formed by financial institutions, regulators, the capital market that will guide and create resources to finance this process, which varies in price. We don't know how much this will cost, but there are estimates of $13.5 to $14.5 trillion a year. So facing these structural changes of this triple crisis and stimulating green sustainable transition places the financial system in the center of the discussion. And the economic reforms, the financial reforms for this to happen, to catalyze this transition, will be huge and fundamental. This crisis causes risks inherent to the instability of the financial system, because this crisis represents a significant alteration in the composition of the economic and financial assets. And the materialization of these risks is still very incipient, and its consequences are still unknown. The channels of transmission that are most known for affecting the stability of the financial system are two. They are the physical risks and the transition risks. The physical risks are a result of changes in the climate conditions, and they are measured by their direct impacts to the economic system. These are the losses that are caused especially by extreme climate events. The transition risks, in turn, they originate from the changes in regulations, the changes in the industries of those sectors that will no longer be significant in the future when we do a transition towards a low carbon economy and an economy with low emissions of greenhouse gases. These are the risks also associated to the introduction of new legislations that are already being implemented. In this sense, climate crisis has become indeed a bigger concern, a fundamental concern for the financial institutions and for the financial regulators in this sense. So, while facing this emergency, the central banks and the financial supervisors are intensifying their efforts to explore different ways of protecting the financial system and not only doing a green sustainable transition. The regulatory apparatuses that are being instituted now, they are adapting to incorporate these climate risks with the intention of mitigating the possible effects on financial stability and not the minimization of the triple crisis only. So it is a fact, it is an evidence that the financial system has reacted to the crisis, and in the agenda of the central banks and the monetary authorities, which is strongly attached to the mandate of fighting against inflation and the search for financial stability, discussions and advances have happened to compress the risks and for their incorporation within the regulatory framework and the normatization of stimuli for the inclusion of environmental issues in the decision-making of the institutions, and also in the formatting of capital markets. This movement of the financial system also places, even though more generally, the incorporation of green instruments in the implementation of monetary policies. And still, and even more incipiently, it has put to the table the normatization of mechanisms that stimulate and induce the direction and allocation of investments for the green sector, and also the destimulation of the what we call brown sectors. But what we notice is the overarching perspective in this financial system focuses basically on the need for information and the measurement of the risks. The climate risks and especially the environmental risks, leaving the social risks a little bit aside. The emphasis in transparency and the analysis of stress test scenarios suggests that these methods are capable of providing quantitative evaluations associated to the climate and environmental crisis. In general, the function of the monetary authority and the central banks is seen as the function of a leader that can influence and may provoke the financial institutions to perfect voluntarily, focusing on voluntarily, their practices of climate risk management and environmental management, incentivizing a reallocation of capital for those more sustainable activities. This view starts necessarily with the assumption that the financial markets are efficient. And the role of the state, therefore the role of the regulators, is to correct market flaws. This perspective is influenced by the neoclassic analytical framework that sees the environment as an extension of the welfare economy. The microeconomic welfare theory that are inserted in the model of market balance. But it's evident that the size of the climate crisis and the environmental crisis and the need to face it fast and abruptly, it would be best if it happened in this decade that is already in the middle of it. It needs a more solid and a new financial system and a restructuring of the international financial system. Therefore, the regulation, more comprehensively that we have done so far, is central to facing this crisis. Not only as a reactive agent, but as a proactive agent as well, that treats not only the stimuli, but essentially the induction of mechanisms of sustainable project investment. These investments, they have to contribute to a sustainable green transition for a state plan, for a country plan that is done in collaboration to guarantee the long-term sustainability. The central banks have to work as public policy instruments, inserted in this more comprehensive context in the center of the policy for the green sustainable transition. The conception on the type of arrangement, regulatory arrangement focused on mitigating the risks, that is mostly used and almost exclusively used so far, hinders the sustainable activities that are essential for this process of transition. Regulation imposes capital requirements that are more strict for those institutions that carry riskier assets, and also imposes the maintenance of minimum net indexes that may have negative effects on the possibility of the banks investing in sustainability, including the public banks and the development banks, whose mission in general is to finance this sustainable transition. The nature of these projects is assessed as riskier, with little liquidity, and with long-term benefits. The green sustainable transition has a high level of uncertainty, an uncertainty that cannot be measured by risk instruments, for a very logical reason, because there are no probabilistic distribution for events that are not gradual and that are not predictable. Nobody knows the consequences of what is going to happen. In this sense, the central banks have to adopt a more comprehensive approach that takes into account at least 4 factors. The integration of the criteria of sustainability in their portfolios, this is the first one. The combination of the prudential regulation with the monetary policies and with fiscal policies with sustainable regulations. And the third one, the work of the international cooperation between especially the monetary authorities, of course, the nation states, but also with the authorities, and the promotion of a systemic integration of the climate dimension and the sustainability in the accounting structures of the corporations to assist the private actors and to assist the public actors in investing in this process of finance. I'm almost over. The operation of the central banks have to be aligned with the political objectives, social objectives, and sustainable objectives of the nation state. So we can have a legitimate process of sustainable green transition. In this context, we argue that the central banks have to take a proactive stance, setting up the financial markets to incentivize more sustainable practices. So based on this notion that the financial markets are not intrinsically the best options and are not intrinsically efficient, and that the monetary policy must and can influence the real variables in long term. The central banks, they can and must address indirectly the certainty inherent to the climate funding. And these policies involve excluding carbon intensive assets from the programs of refinancing of the central banks. It involves also reconfiguring all of the work that these banks are doing, and another more sensitive topic, which is the independence of the central banks. They have to work within a more comprehensive system of promoting sustainable development, working as a branch of public policy in partnership with the state where they are. Thank you very much.
Okay, thank you so much for all of these interesting presentations. And so we can have a discussion now. Open, please, for discussion. Who? Okay, Chandru, please. Where is? Okay, she's there.
Just a question to Liang, that I think you didn't have enough time to explain to us what calibrated integration means when we look at the Chinese experience. So given your whole use of Minsky and Jan's ideas, etc., of this notion that by design developing countries are plugged into a system in which they're riding upon the scheme. So I mean, it's not that China, I mean, even I'm leaving out foreign direct investment. It's not that China wasn't a recipient of significant capital flows of other kinds, portfolio flows, and maybe investment in some bond markets. So in what sense are you saying that there is a calibrated integration from which other countries can learn?
Okay, more question, please. Okay, please.
I agree that one has to have capital controls, and I also agree that basically development should be based on resources which are domestic. But the point is that the financial resources are not enough, and I would have wanted you to say something more about having a sufficient supply of wage goods and so on. There's a very well-known quote by Kaliski that the financial problem of resource mobilization is the real problem of raising the rate of growth of agriculture.
Okay. Please. Okay.
Hello, good afternoon. Thank you for your presentations. Regarding the discussions on financial regulation, I wonder, well, we all know that Basel III has adopted macroprudential instruments for financial regulation. And so in a change, transformation, a shift from later instruments based on market stability or the trust in the market to stabilize itself in Basel II. I wonder if that represents in a particular small or specific way a possibility of shifting the consensus which that is the backbone of international financial architecture so far, that is a more closely related to neoliberal ideas, and if we can expect, or as Professor Nkosi mentioned, this necessity for developing countries to manifest a different idea, different consensus regarding financial regulation or regarding the structuration of the international financial architecture. Thank you.
Okay, someone in the end there of the room, please.
Sorry, em português. Para Fernanda, me pareció fundamental la última parte de tu explicación. Creo que la cuestión del Banco Central, no sé si...
It was fundamental for me. I don't know if it was very clear because I don't know if you're aware about the problem in Brazil concerning this connection between the central bank and the developmental policies. It should be another element added to this discussion that was not mentioned.
Someone else, please? No. Okay, I will just add one personal question to my friend Fernanda. It is you focus on the role of the central bank, and but there is other authors actors that are involved in the public policies, and I am thinking if it is not, it's necessary to have some change in the monetary policy of the general policy of central bank, but if it is not expected too much of the central bank to be the main protagonist of this process. It's just to think about this question. Okay, I will begin on the right, please. Liang?
If I can just ask to show the PowerPoint, just the slides that I want to quickly just show some of the data. So when I say calibrated, for one is I think this idea of limited exposure, really again, utilize external financing when it's necessary. That go back to the question about, how do you mobilize domestic resources? And there's some real resources constraint that you have to overcome by tapping into global markets or regional coordination or cooperation. So those are the things I think, it's necessary to introduce some external financing, given the world that we lived in. This, you need the foreign currencies to purchase goods from, countries. But I think for China, the first thing is, limited exposure to the international, I would say the sort of financial system. When you look at the top panel here is compare China with other developed countries when it comes to their external assets and also liabilities. And then the bottom one is to compare China with other emerging markets. So overall, what you see is there is limited exposure when it comes to allowing for Chinese residents to acquire assets abroad or receive investments from abroad and take on the liabilities. So I think, this is what I would say is a deliberate kind of decision on what to introduce and what not to. And second, I think in terms of the approach, it's very, in a way, sort of, it's graduate. It really, like I mentioned, some of these regulations, they have both residency in terms of year requirements. For example, for the QFII, the qualified foreign institutional investors, they have residency requirements. For example, you have to stay for a year and your profit repatriation cannot be more than 20% for the following year. And you have a $20 million requirement of threshold of investments. You can only invest up to individual projects 1 billion, and then the total aggregate quota is 150 billion. So there's a lot of these kind of restrictions on the portfolio investments. And then for FDI, like I mentioned, some of the service sector are still off limits for these international investors. And if they do, if they are allowed in certain sectors, for example, in automobile, right, this again is one of the biggest, U.S. pain point, right? To say that, China, when the automobile companies come in, they have to form joint ventures with the Chinese automobile makers, right? So the goal, of course, again, is for that technological spillover. So I think that's what I would say is a very deliberate and calibrated approach. Now, when it comes to the resources, I totally agree. I think, certain countries, they have limited resources at their disposal. So they do have to, in a way, purchase or imports from others. And a lot of times that purchase have to be done in the dollar and other dominant currencies. But at the same time, I think when we see the countries, for example, Kenya, they took a loan from China, of course, to build that standard gauge railway, $3.6 billion of debt, loans, at a really good, I think, concessionary rate, the 2.5%, 20-year with a 7-8 years of grace period. I mean, no doubt it's a very good loan. I think, it's good to take it. But at the same time, when the Kenyan government agree with this project, they also take on another 10% of financing. And they write an agreement with China, which is that China's companies, the construction companies, have to localize the resources, supplies of 40% of the project. Okay? So in other words, 40% of the Chinese loans are used to purchase resources from Kenya locally. So then it's a question, right? Why do you need the Chinese loan to mobilize that domestic resources, right? You could borrow some if you need the Chinese technologies, you need the professional managers and workers or what have you. That makes sense. But if that resources ultimately come from your domestic, right? Then why do you need the external loan for you to mobilize that? Right? And we hear all kinds of reasons for developing countries to borrow. Nigeria, for example, right, talked about how they have to borrow foreign currencies to subsidize their fuels or pay their public servants, right? When the 10 states borrow from the central government to pay their servants, there's a huge national outcry and say, this is monetizing the loans and so on and so forth. But then when they borrow externally, somehow this seemed to be okay. Right? And I think that just doesn't make sense. I mean, the only thing, well, not the only thing, but one of the constraints of domestic resources mobilization, of course, is inflation, right? But if the government already spent the money, why do you care the way they finance it? Is it by money creation or is it by loan? The spending has already been done, right? If that generates inflation, that generates inflation. So I think that that's really the more of a question about, why do you need to borrow externally? It's a question that I think countries need to think twice or 3 times more about. And then I know that I was mostly focusing on China as a individual sort of country experience. I didn't really get into the international sort of cooperation or regulations. We know that there are all these institutions that are in place, right? IMF, World Bank, BIS, the Basel Committee on Banking Regulations, FSB, Financial Stability Board, that was set up after the global financial crisis. All these are institutions that are supposed to, regulate at a more international coordinated basis. But I think all of them are very similarly. They are regulating based on the recipient countries. And IMF I have actually slides, if I can even just show it. It has really interesting evolving views on the part of IMF when it comes to capital control, right? The 40s, when the article agreements were set up, they are very open, give a lot of latitude to capital controls. And that started to erode since the 90s, right? A lot more promotion for deregulation. And then that came with the Asian financial crisis, and they stopped trying to promote more financial deregulation. But still, countries, they themselves voluntarily start to deregulate. So I think that's the problem. I think the IMF these days, especially when they had a new update in 2022, they allow for a lot more capital control measures. The idea is as long as you don't jeopardize the global financial stability, you are allowed to use certain capital controls once you exhaust other means, which I think is very fluid. So I think there's large room, which is what I'm trying to say, for countries to exercise their own autonomy and their independence policy in terms of capital controls. I think really the barrier is to really understand what these foreign capital can or cannot do. So I'll stop here. Thank you.
Thanks. Firstly, macroprudential policies are very important for these systemic risks that we experience in the financial architecture or just globally. but they can be used beyond financial stability. And I think why the regulations are insisting on financial stability, because this is the primary issue for advanced countries, because of the banks which are systematically important. Now, our banks may not be as systematically important, but nonetheless are important for development purposes. We can therefore request, I think Brazil and South Africa are in a position to say that while obviously macroeconomic policies are important, they should serve beyond financial stability. We need financial inclusion. It's a very important area for the developing world. Macroeconomic stability generally as well could actually be effected through macro prudential policies. But also there's a weakness in the current system because it's based on a theory of banking that is wrong. That's why you find that the Basel I, Basel II, and indeed Basel III are going to fail. All right? Because they're basically piling up regulatory, the regulations on a theory of not how banks work, not how money work. All right? There could be a lot of simplification if we actually understood banking from the heterodox perspective, and therefore put regulations as per heterodoxy, as per what banks are today, as manufacturers of money, for example. So I think it is incumbent, obviously, incumbent upon us as developing countries to begin to say, let's expand the use of macro-pru beyond financial stability to include financial inclusion, because it's a big subject for us, but also the stability of the macroeconomy as a whole. And that, whether we want it or not, just as much as Basel III, Basel I failed, Basel II failed, and Basel III is unlikely to work. Yet, the complexity of the regulations is very difficult. It is so high that it's not so easy for developing countries to implement that. It's just so complex, and it's an issue that I think we have to continually raise at the G20 here and G20 in Pretoria to saying, I think we're taking the wrong path. Hence, therefore, the track, the T20 track, and indeed, this university here and IDEAS must necessarily come to assess the G20 in regard to how to begin to put appropriate regulatory environment for our economies to thrive. I mean, small, medium enterprises, as a consequence of this Basel III, some people call it Basel IV, are not going to have sufficient financing, from public banks or just banks, because it is tightening the screw on credit. And obviously we know credit is fundamentally important for not only just ordinary development, but just the financing of life generally. So I feel we have a duty. Brazil has a duty, and other developing countries to begin to enlighten the G20 and the West as well as a whole. That firstly, we've been basing our thinking on the wrong theory, and therefore the outcomes are wrong, and are going to be wrong going forward.
Fernando.
Obrigada, Luiz. Começar pela...
Thank you. I'd like to start with Graciela.
To people can put it, the device. Okay. She will speak in Portuguese. Okay.
I like my language. Graciela commented about this historic mistake, that is the independence of the central bank. It's inconceivable to think about this independent central bank beyond the needs of development and sustainable development that must be quick and must happen suddenly. And we should think about this central bank with this idea of having a mandate or a dual mandate of economic stability, working many times in a political way, based on technical arguments in a political way, against the objectives of an elected government, whether we like it or not, this government. This is something transient. It's a historic moment of this need of an independent central bank. This is a convention based on this Washington consensus that you must have an independent central bank. But independent of whom? Because it's relying in someone. That brings this question of my dear friend Luiz, something that we discuss a lot. The central bank is one of the most important actors in this climate transition process, simply because the financial system is the lung of capitalism and is responsible for funding the climate transition. But it's not up to that agent to make policies. It's up to this agent to follow the policies. It's one of the big players, but it's not even the main one. We must count with a strong national state, with our good old public banks, especially development banks, multilateral development banks, because this is a cooperating process, international cooperating process. So we need funds, we need international cooperation. We must revamp the international mechanisms as we discussed yesterday. They are not serving their purpose right now as agencies, institutions. It's one of the few actors. It's not even the main one. Thank you.
Okay, it is 3:30. Any further question? So it's okay. Thank you so much for this presentation, everybody. Okay, we'll finish now this section. Bye.